Today we are looking at the 10 best dividend stocks to buy in February 2024. This is from the latest Forbes article. We're going to run through every single one of these 10 best dividend stocks to buy now that you see on your screen. Not only are we going to run through each of these companies, we're going to look at their historical performance over the last few years. We're going to take a look at their dividend safety. We're going to run through their important financial metrics, whether or not these are strong companies to invest in over the next 5 to 10 years. We're also going to run them through the valuation model. We're going to get to the intrinsic value as well as our acceptable buy price given our investor margin of safety, and we'll look towards Wall Street to see what they forecast over the next 12 months. On top of that, for each one of these 10 companies, we are going to take a look and see exactly why Forbes have picked these companies. We'll run through some of the narration and discuss whether or not these are some strong, solid picks as well as and when we go through. And finally, for those that want to understand how Forbes went about picking these 10 stocks, if you do want to take a look, I won't run through every single one, but you can pause the screen and just read that each one of these did meet all of these criteria as set out through their methodology. So let's jump to pick number 1, which as you would have seen above is Texas Instruments. Now, before we get into the numbers, one of the reasons, or in fact the reasons why they have picked this company, we can see they have an A grade for financial health from the Morningstar. It is something we discuss when we talk about companies about being very healthy, especially on the balance sheet side. We can see they're expected to continue 10% earnings per share growth over the next 5 years. They have a dividend which they raise steadily year on year. We can see above here 3.3%. 5-year average growth at 11%, and they can say as well that the stock has outpaced the S&P 500 by 5.1 percentage points over the last decade. So as you see here, the S&P 11.5% yearly returns over the last 10 years, Texas Instruments 16.7. So now let's get into the numbers of Texas Instrument. It is the first one we're looking at out of the 10 today. Now, this company is down 7% over the last year. It trades in the midpoint of the 52-week range. In terms of a forward yield, it is 3.2%. Forward PE of 31.3. And if you've been holding this company over the last 10 years, you would be up 270%. Do bear in mind, this doesn't include those dividends reinvested. So let's jump into their dividend safety. They have a score of 80. It is safe. Market cap 148 billion. It is a mega cap company. Now, for those who see a recession inbound in 2024, well, they increased the dividend during the last recession 07-09. They had below average growth, negative 27% versus the S&P's negative 12%. But they did underperform the S&P, negative 59 versus the S&P's negative 55. Dividend growth 4.8% last September. Now, yes, it is above the inflation rate that I advocate on the channel, 4% or more, but a little bit disappointing as the last 5 years as well as the last 20 years, we see some very strong double-digit dividends year on year. In terms of a dividend growth streak, well, they have been increasing those dividends for the last 20 years. They're 5 years away from becoming a dividend aristocrat. In terms of dividend yield theory, for those that are new to the channel, it states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, but do bear in mind we're not looking at any of these models in isolation. Forward P, on the other hand, sits above the 5-year average, 31.7 versus 23.3. And when we compare it to the information technology sector PE, information technology 26.8 is lower than TXN. Again, for new viewers, we do focus on the free cash flow payout, and you're about to find out why. The earnings is susceptible to manipulation by management through accounting. Many reasons, we've gone through this on the channel. What we like to see on the free cash flow, below 60%, although some people like to be industry specific, 50% for semiconductor firms. The reason why I like 60% gives me faith that management are able to offer those double-digit dividend increases we love to see. Now, this is why we focus on free cash flow. If you were to look at earnings at 71%, you would say it's not too bad. It is a bit over the 60%. However, the true story to be told is here on the free cash flow payout. What this signals in 2023 is that management paid out more in dividends in 2023. In fact, more than 3 times, in fact 4 times what they received than what they generated in free cash flow. So a very big red flag indicator. 2024, again, they are expecting to pay out more in dividends than generating in free cash flow, something just to be aware of. Free cash flow per share, it has increased from $3.45 to $6.47 in 2022, but we do know it dropped significantly in 2023, and whilst it is expected to pick up in 2024 to $2.55, that is below the 2022 figures. Sales growth, as we can see, typically we like to see on the channel a steady moderate growth of 3 to 7%. Nearly there every single year, although we do note 2023 was the worst year it's had over the last decade, with a negative 13% drop to the top line. Therefore, numerically, we can see it has gone from 13 billion to 18 billion in 2023. What we quite like to see on shares outstanding is it to decrease, as effectively it means that the companies are returning those excess cash to investor pockets. 1.08 billion in 2014, 916 in 2023. ROIC, now for me personally, this is one of my key metrics. What I like to see here is around 10% or more. It gives me faith that management are able to effectively allocate their capital. And if you want to see my 6 other golden dividend metrics, be sure to sign up to my free weekly newsletter. The comments is in the pinned comment below. You can grab up a copy. I've run through different articles week on week, completely free as well. So what we can see on the ROIC, very strong. It is above the 10% minimum I like to see, and very, very strong even in the last year following a big dip from 2022. In terms of the margins, very strong as well. On the operating side, we can see it has in fact been increasing over the last 10 years, well above the minimums. Very similar story for the free cash flow margin, although we do note their free cash flow did drop significantly in 2023. This would be an area that I would keep an eye on moving forwards if I was an investor or a potential investor. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us 2 things: dividend safety as well as balance sheet strength. 2023, what this signals that it would take them 0.37 years to pay off all of their debt net of cash on hand, well below the 1.5 that we look as a maximum. 2024, even though it is expected to increase, is still well below. Therefore, no worries with the dividend safety and no worries with the balance sheet as well based on this information. So let's jump into the valuation for Texas Instruments. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we run through every single one of these models to get to the intrinsic value. For today's episode, we are going to just jump straight into the final calculation. So the intrinsic value arrives at $183. And what we can see here is that we use a margin of safety. Now, we start off with 10%, which is what we use if we believe it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. For TXN, we pretty much see around a 10% margin of safety up to 165, which isn't too far off the current trading price. In terms of Wall Street and what they see, well, their price target is $174 with upside of 7% over the next 12 months. As we go through, do let us know your thoughts in the comments below whether any of these 10 stocks to buy in February are ones that you are picking up or you're adding to your watch list. We then move on to the second stock from the Forbes article, which is Air Products and Chemicals, ticker symbol APD. Now, it is an industrial gas supplier. It has been in the news, and we did do a deep dive on this company after its earnings. Now, again, one of the reasons that Forbes like it, they do have an A financial health rating, and they expect the company to continue growing its earnings per share by 10.3% year on year over the next half decade. And we can see another reason they like it is below its 52-week trading high and has been in the S&P. Again, another stock, 2.5 percentage points per year over the decade. Not over the longer term, but per year. So let's get into Air Products and Chemicals. Now, this is down 23% over the last year, trading pretty much at its 52-week low. If you've been holding this over the last 10 years, you'd be up 103%, but we do note it is some way off its all-time highs at well over $300. It also offers a yield of 3.22%, and we can see a PE just under 18. So let's take a look. Dividend safety score 95, very safe. Market cap 49 billion. And when we take a look at those recessionary metrics, well, they increased the dividend during the last recession, below average growth and near recession return at negative 52%. Not a great increase in this year. In fact, last month, 1.1%. So it is an increase below that 4% inflation. Although we do know over the last 5 years and the last 10, 20 years, it has been increasing double digits. And they are a dividend aristocrat and 9 years away from becoming a dividend king. So let's take a look at dividend yield theory. We can see a double sign of undervaluation, one on the yield being higher than the 5-year average, and another sign with the forward PE being below the 5-year average as well. And we do note it is pretty much in line with the materials sector PE of 17.7. So let's take a look at the free cash flow payout. A lot of worrying signs here. In fact, the last 1, 2, 3, and 4 years, they were paying out more in dividends than generating in free cash flow. And we see negative in 2023. As we're about to see, they had negative free cash flow per share. So there are a few red flag indicators here. And as we just mentioned above, negative 639 in 2023. In terms of sales growth, very, very inconsistent. Some years double-digit growth, a lot of years flat, and some years negative. We do want to point out that in 2023, their top line did drop by 1%. In terms numerically then, 10 billion in 2014 to just under 13 in 2023. They also do the opposite of what we like to see. They issue shares, although not massively. It has increased by around 8 million from 215 to 223. In terms of the ROIC, nice to note the consistency around that 10% mark. We can see it has been decreasing from 2019, so it may be one area just to keep an eye on. Free cash flow margin, operating margin, well, on the operating side, it has been increasing above the minimum, so that is positive. Free cash flow, probably somewhere that I would keep an eye on as a potential investor. 2022 and 2023, well below that minimum 5% we want to see for companies we want to invest in. Net debt to EBITDA. Now, I want to be positive here. It is below 3. The only thing I would say is that from 2019, it has been increasing. 2024 at 1.99 expected. Still below the 3, but just something that I would say keep an eye on if you are looking to invest or if you are an investor in those latest quarterly reports that do get released. So what about Air Product Chemicals valuation? So let's get into the intrinsic value. And as always, you can grab a copy of this model if you want to get to the intrinsic value and acceptable buy price of companies in your own portfolio by clicking on that pinned comment below. Margin of safety then at 10% at buy up to 242, at 15% at 229, and at 20% it isn't quite there yet. So for APD, we see around a 15% margin of safety. In terms of Wall Street and what they forecast, well, over the next 12 months, they do see this as a fairly strong buy. They have a price target of $275 with upside of 24%. We then move on to stock number 3, which is LMT, Lockheed Martin. Again, one of the largest defense contractors in the world. Now again, another A rating for their financial health. Their EPS has been growing at more than 20% per year, which is absolutely phenomenal. And even though this is expected to slow down, they do still see this respectable average of 10.7% per year for the next 5 years looking healthy enough. And again, it has outpaced the S&P 500 4.6 percentage points per year for the last decade, which is very important to understand. It's not over the last decade, but per year over the last decade. Now, in terms of the metrics and the analysis, well, over the last year, they're down 9%. Over the last 10 years, up 162%. Again, a little bit away from its all-time highs at around $508. The forward yield, just under 3%. Forward PE, around 16.4. And when we take a look at the dividend safety, a very safe score of 84. Market cap, 103 billion. It is a mega cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession, above average growth, and also outperformed the S&P 500. Dividend growth, not too bad, 5% increase in October 23, 8% over the last 5 years, nice double digits over the last 20 years. And in terms of their dividend growth streak, 21 years of increasing that dividend. So dividend yield theory for LMT, we have a sign of undervaluation, 2.95 versus 2.66, although we do note the forward PE 16.4 is above that 5-year average. In terms of the industrials, well, it in fact sits higher, the sector P at 19.5. Taking a look at the payout ratio, pretty consistent over the last 10 years. We do note that year in 2018, but other than that, pretty strong and expected again to be nice and low at 51% in 2024. Free cash flow per share has also been increasing, moving in the right direction, always nice to see. We do note the inconsistencies, nonetheless, it is looking positive, but just something to draw your attention to that in 2024 it is expected to be flat from the previous year. Sales growth, nothing too fancy to note here. It is pretty much moving along, chugging along between the 3 to 7%, although the last 2 years weren't the greatest with negative growth as well as just 2% of the top line. Numerically though, 40 billion to 68 billion over the period. Shares outstanding, I do quite like to see some small consistent buys, even there if they are just a little bit year on year. It has reduced from 322 to 251, always a bonus for investors to see those share buybacks. Absolutely phenomenal ROICs, double digits, very strong year on year. Yes, it is inconsistent, but nonetheless, these numbers are very, very strong for any company to pull out. Operating margin looking very healthy. It does straddle around the 12%, but no real scares year on year. 13% in the latest year, looking good. And the same to be said for the very nice and consistent free cash flow margin from Lockheed Martin. Net debt to EBITDA below 3 for the majority of companies. 2.29 in 2023, pretty much expected to be the same in 2024. So nothing really to point out here. No red flag indicators for LMT. So let's get into the valuation, the intrinsic value, and for today's episode, we get to a value of $497. In terms of the margin of safety, we start off with 10%, so it is a buy up to 447. 15%, it isn't too far off, it's a few dollars shy, so I would be happy enough to say that based on our estimates and judgments, we see around a 15% margin of safety. In terms of Wall Street and their forecast, well, they see upside of 11%, their price target of $475. And don't forget, as we go along, let me know whether or not you have been adding any of these companies that Forbes are recommending as strong buys. We then move on to the next company, which is McDonald Corporation, ticker symbol MCD. Again, a very strong financial health rating of A+, or A. In fact, they expect the company to grow the earnings per share 9% over the next 5 years. And what they are mentioning here, this is one of the lowest expected growth rates on the list, but still the 9% is above the median of the S&P of 8.7. And we can see over the last decade, they have been outperforming the S&P with an average of 2.2 percentage points year on year over the last 10 years. So McDonald's Corporation up 11% over the last year. Over the last 10 years, 202%. We do see currently they are in the mid to upper end of the 52-week range. A yield of 2.31% and a forward PE of 23. Dividend safety score then 77. It is safe. Market cap 210 billion. We're talking about a mega cap company. In terms of those recessionary metrics, while they increased the dividend during the last recession, above average growth, -6%, and they did outperform the S&P, -3%. And one thing I do want to point out here and draw your attention to is if you're a regular viewer, you will note that this is one of the best recession returns from any company during 07-09. Dividend growth streak, love to see that, 9.9% last October, 8% on average over the last 5 years, and some strong and healthy double-digit increases over the last 20. They're also 3 years away from becoming a dividend king as well, nearly 50 years of consecutive increases to that dividend. In terms of dividend yield theory, pretty much reasonable valuation, both on the yield and on the forward P that we see on screen. And we do note the consumer discretionary does sit much lower at 14.7. So when we look at the free cash flow payout, what we can see, in fact, it has been decreasing over the last 10 years. As I mentioned, for me, 60% or lower is ideal. So to see that in 2023 it was 63%, 2024 coming down to 54% is quite nice. And I do believe that we will see a nice, strong single-digit dividend increase or a low double-digit increase this year to McDonald's dividend. Free cash flow per share also has been increasing, pretty much more than doubled, and is expected to go even higher in 2024. Sales growth, now this is one part that we would like to see improve over the next few years, but they did go through a period of negative growth to their top line. We do note the latest year, 2023, 10% increase to that. And when we look at that numerically, it has in fact decreased from 27 billion to 26. Shares outstanding, whilst not consistent, they have lowered that down aggressively, 986 in 2014 to 732 in the latest period. ROIC, double digits, not much to say here. Very strong, very healthy. 25% in 2023, looking very good. And what I would say, operating margin and free cash flow margin, not only are they above the minimums that we look for, but look at that, they have been increasing. So they have been becoming a lot more efficient on that margin. And we can see the very same argument to be said for the free cash flow margin as well, looking very strong even in 2014, but it has only been getting better and better year on year. Finally, net debt to EBITDA, 2.77 in 2023, expected to go lower in 2024, and it is below the 3.5 target that we've set as a maximum for restaurants. So let's jump into the valuation for McDonald's to see what the intrinsic value gets to for today, and what we see is $330. Now the current price at $289, again margin of safety at 10%, a buy up to $297, 15% not quite there yet. So for MCD we see around 10 to 15% margin of safety. In terms of Wall Street and what they forecast, well they have a price target of $324, upside of 12%, so they do believe it is a buy at the current value. The next stock that we're taking a look at from this list is ADP, not to get confused with APD, automatic data processing. So this stock now has a B financial rating from Morningstar. It's grown its EPS very strongly, 16.2% over the last 5 years. And whilst that was very strong, analysts are still expecting a strong and healthy 13.5% year on year over the next 5 years. And we can see here that is the highest expected growth rate on this list. And again, this is another one that has beaten the S&P by an average of 3.8 percentage points per year over the last 10 years. So let's get into the numbers. Up 12% over the last year. Over the last 10 years, up 271%. Very strong, and we can see it's still not at its all-time highs at around $270 at the back end of 2022. They do trade right now towards the upper end of the 52-week range, a yield of 2.24% and a forward PE of 27.4. Dividend safety, one of the safest scores you can get, 99, very safe. Market cap, 103 billion. It is a mega cap company. Key recessionary metrics, well, they increased the dividend during the last recession, above average growth, and also outperformed the S&P 500. Pretty good, in fact, as good as it gets. Double-digit increase last year, double-digit increase over the last 5 years, double-digit increase year on year. This is a very strong dividend growth company, and in fact, this year they will obtain that dividend king status if they increase it, which is looking extremely likely. In terms of dividend yield theory, we do have a sign of small undervaluation, 2.24 versus 2.02, and the same on the forward PE, 26.2 versus 27.9. But we do know the industrial sector PE does sit lower at 19.5. Free cash flow, pretty consistent around that 60% year on year, although 2023 and 2024 expected is looking much lower, which is always great to see. Free cash flow as well, while it isn't massive increases, it does increase over the period. In fact, nearly 3 times from 2014 to 2023. Nice to see that 2024 it is expected to go even higher. So looking at the sales growth, pretty consistent, 3 to 7%. In fact, the last 2 years have been even better, which is very nice to note. And we do see their top line nearly double from 10 billion to 18 billion in 2023. Consistent share buybacks year on year as well, 483 million to 414. And we can start to see why this is a very high quality company. ROIC, in fact, been increasing as well, a phenomenal 64% in 2023. Operating margin, free cash flow margin, well, the operating efficiency of the company has been increasing, as we can see, over the last 10 years. And the free cash flow margin has just been pretty consistently strong. Now, net debt to EBITDA, you can't really get better than this for a company. 0.28 in 2023, 0.31 in 2024. Alongside all the other metrics, automatic data processing is a very high quality company. So let's take a look at the valuation of ADP. And as always, if you do enjoy the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. 10% margin of safety, so we can see, in fact, this one doesn't warrant just yet a margin of safety of 10%. At 5%, it is pretty much near enough the current trading price. In terms of Wall Street, well, again, very similar. They do believe it is near the intrinsic value. They see 4% upside over the next 12 months for automatic data processing. The next stock that we are taking a look at is Microchip Technology Incorporated, ticker symbol MCHP. Now, this is a semiconductor company, another B score for a financial health rating, and we can see the highest EPS growth rate on the list. Analysts are expecting 12.1% yearly EPS growth over the next 5 years, and we can see here that is the second highest expected growth on the list. And another one here that has bettered the S&P, very strong, 4.3 percentage points year on year over the last decade. So let's look at the numbers. Up 1% over the last year, up 274% over the last 10 years. It is in the mid to upper end of the 52-week range. 2.11% forward yield, PE 17.34. Dividend safety 60, borderline safe. Market cap 46 billion, a large cap company. In terms of those key recessionary metrics, well, they increased the dividend during the last recession. Below average growth, but they did in fact outperform the S&P 500. Phenomenal growth last year, 39%, double digits over the last 5 years, and 23% over the last 20 years. Absolutely incredible. And they have been incurring that dividend for the last 20 years. So let's take a look at dividend yield theory. So we do see, in fact, a sign of undervaluation on the yield, 2.11 versus 1.58. But we do know the forward PE is much, much higher than that 5-year average. Information technology sector PE is also lower at 26.8. So let's take a look at the free cash flow payout. What we do see, in fact, is that it is very inconsistent, although it has been dropping down to 22% in 2023. But we can see 2024, it is expected to go higher at 59%. In terms of the free cash flow per share, it is increasing pretty strongly as well, more than 3 times over the period. But important to draw out that 2024, it is expected to be lower down to 3.07. Sales growth, very strong. Yes, some years it doesn't have the greatest growth, but it does rebound very strongly the subsequent years. So looking absolutely phenomenal over the longer term. And it does show with the top line increasing more than 4 times from 2 billion to 8.44 in 2023. Unfortunately, they don't do share buybacks. They issue shares, so your position would have been diluted over the last 10 years from 435 to 550. We do know some share buybacks, but essentially the net position on this is a net dilution. ROIC, some years okay, some years very strong. The last 2 years, though, looking very nice. Something just to keep an eye on. For about half of the last 10 years, it has been below that 10% ideal target we like to see. Operating margin, again, straddles some year around that, although we do know the last 2 years are looking very, very strong. Free cash flow margin, this looks like a very, very consistent free cash flow machine in the mid to high 30s nearly every single year. Net debt to EBITDA did go very high in 2019. Nice to note that in 2023 it has come down, but just want to draw out that in 2024 it is expected to go higher to 2.59, which is probably why we do see that borderline safe dividend score. So let's get to the stock analysis of this company. Let's find out what the intrinsic value is for today's episode. Now it comes to $110 and we can see the current price at $89. 10% margin of safety, a buy up to $99. 15% $94. 20% pretty much around the current trading price. 25% not there yet. So for MCHP, we see a 20% margin of safety. And in terms of Wall Street, they have upside of 7% with a price target of $92. And as always, do give us your thoughts below of this semiconductor company as well as the others. The next company that we are taking a look at is MMC, Marsh McLennan Companies. Now they provide insurance, risk and consulting services. We can see they have an A rating for their financial health, earnings per share been growing at more than 18% per year, although even though it is expected to slow, they do see this 11.1% as a respectable figure, and they have been outpacing the S&P by 6.1 percentage points per year for the last decade, making it the third strongest performing stock on this list. So let's take a look at MMC, and we can see over the last year they are up 15%. Over the last 10 years, up 315%. Trading at the upper end of the 52-week range with a forward yield of 1.43% and a forward PE of 23. Dividend safety score then 80, it is safe. Market cap 98 billion, a large cap company. In terms of the recessionary metrics, well, they maintained the dividend during the last recession. They had average growth, but they also outperformed the S&P with that negative 29% return. Strong increase to the dividend, 20% last summer, 11% on average over the last 5 years, although we do note it is a little bit slower on the last 20 years on average. In terms of dividend growth streaks, well, they've been increasing the dividends for the last 14 years. And when we look at dividend yield theory, we can see a sign of reasonable valuation on both the yield as well as the forward PE. And we can see, though, the financial sector PE is much lower at 11.2. In terms of the free cash flow payout, below 60% consistently year on year, very good sign. Free cash flow per share more than doubled over the last 10 years. Granted, it hasn't been consistent. Also nice to note, though, 2024 is expected to go higher. Top line growth, very respectable as well. 3 to 7% pretty much every year. And in fact, the majority of the years are looking even better. 2023 notably double digit 10%. In terms of that numerically then, 13 billion to 23. Shares outstanding, we can see not very consistent. Nonetheless, they have bought back around 54 million worth of shares at around nearly 10% of that initial amount in 2014. When we look at the ROIC, very positive. Even the years where it did dip, it did bounce back very strongly. 20% in 2023 looking very healthy. Both margins looking very nice. Operating margin has been increasing over the last 10 years. And you could argue the same for the free cash flow margin. No worries on their margins whatsoever for MMC. And when we come to the net debt to EBITDA, not only has it been decreasing from 2019, 2024 expected to go even lower at 1.66. So no real worries based on the information on their dividend safety or in actual fact on their balance sheet that we can see on this high level review. So let's get to the valuation of MMC, and what we can see for today's episode, the intrinsic value arrives at $237. Margin of safety then, when we start off with 10%, it is a buy up to 213, at 15% a buy up to 202, and at 20% not quite there yet. So for this company we see a 15% margin of safety. In terms of Wall Street, they don't see too much upside, in fact only 3%, with a price target of $205 over the next 12 months. The next company that we are looking at is UnitedHealth Group Incorporated. We can see A grade for their financial rating. Analysts expecting 11.9% yearly EPS increase over the next 5 years. And we can see here it is the strongest performing stock on the list, outperforming the S&P by an average of 13.1 percentage points per year over the last 10 years. And this is one that I recently added to my portfolio. I already had shares, but in fact I added more, and I did discuss that on a video a few weeks ago. So let's take a look at the information. Over the last year, they are up 7%. Over the last 10 years, up 605%. They're trading in the mid to upper end of the 52-week range. A yield of 1.45%. Forward P just under 19. In terms of dividend safety, a score of 99, very safe. Market cap 479 billion. They are a mega cap company. Recessionary metrics, well, they maintained the dividend in the last recession above average growth, but they did unfortunately underperform the S&P with their negative 63% return. Double-digit increase to the dividend last summer, double-digit over the last 5 years, 41% per year over the last 20 years, a phenomenal number there. And they've been increasing those dividends for the last 14 years. In terms of dividend yield theory, well, we can see here reasonable valuation, 1.45 versus 1.43. Forward P 18.6 versus 19.9. And when we look at the healthcare sector P, it is slightly lower at 17. So let's run through the payout ratio and other metrics. So payout consistently, in fact, forget 60%, below 30%. Very nice to see. I would be shocked if we do not see a nice double-digit dividend increase this summer. Free cash flow per share, probably one of the most consistent increases year on year for a company. It isn't very consistent, I know, but if you just look at that year on year and compare it to other companies, it is what I would say as one of the most consistent. 2024 expected to go higher to $30.50. Sales growth very strong, double digits nearly every single year, 15% in 2023, very strong, very healthy. And we can see they have nearly tripled their top line from 130 billion to 372. One thing that they don't do as often that maybe I would like would to be those share buybacks. We see whilst they have done it, 986 million to 938. I would have liked to see this a little bit more aggressive. ROIC, very strong, very healthy, very consistent, high teens in terms of the numbers, 20% in 2023, looking very positive as an investor. Operating margin, this is one area that I would like to see them increase. Nice to note the last few years has been increasing. 9% in 22 and 23. I would like to see this near that 12% we want to see. However, nonetheless, still looking very positive. Free cash flow margin straddling around the 5%, but again, nice to see it has been consistently above that over the last 8 years. In terms of the net debt to EBITDA, 0.91 in 2023, 0.79 in 2024. We can see this dividend is very safe and the balance sheet does look healthy. So let's get into the valuation of UnitedHealth, and what we can see for today's episode is the intrinsic value is arriving at $610. Also remember, you can grab a copy of the valuation model if you want to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. Margin of safety then, we start off with 10%, a buy up to 548, at 15%, 518, so pretty much bang on the current trading price, so we see a 15% margin of safety. In terms of Wall Street and what they forecast over the next 12 months, they have upside of 15%, and they have a price target of $593. As always, let me know if you are adding this company or any of the others. Stock number 9 that we are taking a look at from this list is Hubbell Incorporated. They are an industrial conglomerate selling everything from copper and fiber cables to audio and video cords. We can see they have been given an A financial health rating, and they're expecting to grow their earnings per share by 10% over the next 5 years. And we can see they have beaten their S&P by around 1.1 percentage points year on year over the last decade. So let's take a look. They're up 51% over the last year. Over the last 10 years, up 201%. Very strong. They are trading now towards the upper end, or in fact at their 52-week high. The yield on offer is 1.34%. Forward PE at 22.32. Dividend safety score, very safe at 83. Market cap, 19.5 billion. They are a large cap company. Recessionary metrics, while they increased the dividend during the last recession, they had average growth of negative 12.9%. And when we look at their dividend growth, fairly solid, 8.9% last October, 8% over the last 5 years, 6% on average over the last 20 years. And we can see they have been increasing those dividends for the last 16 years. So let's take a look at dividend yield theory. We can see they are having a sign, in fact the first one, of overvaluation, 1.34 versus 2.17. And we do note the forward PE is slightly higher at 22.1 versus 20 on that PE forward-looking basis. Industrial sector PE, 19.5, is also slightly lower. So in terms of the free cash flow payout, consistently below 60%. Nice to note that 2023 and 2024 are around that 33 to 34% level. So it's good, strong dividend increase should be expected this year. Free cash flow per share more than doubled over the last 10 years, 14.80, expected to go higher again in 2024, which makes sense given how strong this company has been performing. Sales growth last 3 years looking very nice and healthy, 9% in the more recent year, and numerically when we take a look we can see it has nearly doubled from 3.4 billion to 5.4. They do share buybacks, although they don't have many shares outstanding to begin with. Not massively, but it has gone from 59.2 million to 54. In terms of the ROIC, double digits again, nothing really to note other than it's very, very strong. So that's always a good sign when analysing companies. Operating margin, very strong and healthy. Likewise, the free cash flow above the minimums that we can see here on screen. And the net debt to EBITDA, no real worries to point out here. 1.69 in 2023, 1.52 expected in 2024. So what about the valuation of HUB? Let's find out whether or not this is undervalued. And the value that we get for today's episode is $346. Now with a current price of $364, what this signals to us is that it's currently trading above its intrinsic value and therefore it is overvalued and there is 0% of a margin of safety. In terms of Wall Street, well, they also agree with us. They see negative 3% upside to this stock over the next 12 months with a price target of 353, the first one that we have seen where we have the intrinsic value higher, in fact lower than the current price. We then move on to the final company, which is Leeven Health. Now, this one has a B-grade financial health rating. It's strong earnings of 9.3%, increasing year on year over the last 5 years, and it expects to get even stronger to 11.8% over the next 5 years. And we can see here that this is the second best performing stock on this list over the last decade, outperforming the S&P 500 by 8.3 percentage points per year. Remember, the first was UnitedHealth. So let's take a look. Over the last year, it is up 4%. Over the last 10 years, up a very strong 476%. They are trading now at the 52-week high point. The yield is 1.3%. Safety score comes to 99, very safe. Market cap 119 billion. It is a mega cap company. Key metrics, well, there was no dividend paid during the last recession, and they had above average growth, but they did underperform the S&P. Dividend growth, double-digit increase last month. Love to see it. Last 5 years, 15%. Last 10 years, 15%. Very, very strong. And they have been increasing those dividends for the last 12 years. In terms of dividend yield theory, what we can see here, pretty much reasonable valuation, both on the yield, both on the forward PE, pretty much nearly in line with their 5-year averages. But we do note the healthcare sector PE is much higher at 17. In terms of the free cash flow payout, very low, below 30% nearly every year, which does come as no surprise given their very nice dividend increases. And what we can see on the free cash flow per share, it has been increasing over the last 10 years. But again, not very consistent. But again, 2024 looking very strong as an increase. So remember, in the longer term, if you hold these companies for the long term, high quality companies tend to perform very well over a long period of time. Sales growth, double digits over the more recent period. Very nice to note, 9% in 2023. And numerically, we can see they've more than doubled their top line, 74 billion to 171. On top of that, they have returned that excess cash to shareholders. 286 million shares outstanding in 2014, in fact, 237 in 2023. ROIC, very strong, very consistent, above that 10%. Love to see that. And their margins are somewhere that do leave to be desired. As we mentioned, very similar on UNH as well. Nonetheless, both of them have been very consistent. Their margins have stayed the same and they have continued to outperform the S&P 500. Then when we look finally at the net debt to EBITDA, probably the best balance sheet that we have seen of these 10 stocks. It wouldn't even take a Leeven Health one day to pay all of their debt net of cash on hand. So how does the valuation stack up? And as always, if you've enjoyed today's episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety then, 10%, we can see there. The acceptable buy would be at $500. So right now, when we take a look, it do have around a 5% margin of safety. In fact, between a 5 to 10% margin there. So 5-10% margin of safety for Leeven Health. In terms of Wall Street, well, they forecast upside of 12% with a price target of $567. As always, if you've enjoyed today's content, smash that like button, hit that subscribe and bell button. I'd love to see you all on the next episode. If you enjoyed today's content, let me know. I can do more of these type of content. And don't forget to join us on those free weekly newsletters that we do bring. And remember, we do talk about our undervalued screener, finding those undervalued golden stocks. As always, I'll see you on the next episode. For now, take care and have a good day.